Hello and welcome to this week's edition of Echo45 Advisors Market and Economic Update. In this video, we'll be discussing the escalating trade tensions between the United States and China and what it means for markets, and the significant economic interconnections between the two countries. The White House has announced a 90-day pause on tariffs on most of our trading partners. This now puts trade tensions between the U.S. and China in focus. Tariffs have escalated to unprecedented levels, including 145% on Chinese goods by the US and 125% on American products by China. The current tensions reflect a deeper shift to a multipolar world where both countries exert significant global influence, replacing the post-Cold War unipolar American dominance. While the situation is still evolving, the deep economic connections between the US and China are unlikely to go away. History suggests that markets and the global economy can be resilient, even if there is some short-term volatility. In environments like these, it's important to maintain a long-term perspective as an investor. First, this chart shows U.S. trade with China over the past 2 decades. It highlights trade activity from the perspective of the United States. Specifically, the U.S. imports many more goods from China than we export. This is still true when we include services that we export to China. Current tariff levels above 100% would potentially more than double the price of goods traded between the US and China, all things being equal. Investors are concerned not only due to higher prices, but because it has been unclear how far the administration would go in these negotiations. The administration's 90-day pause on tariffs on other countries suggests that the White House would still like to achieve new deals. The fact that goods like technology products are exempt from tariffs also suggests that the administration is sensitive to higher costs and the impact on companies. In 2018 and 2019, companies demonstrated resilience in the face of tariffs by adjusting supply chains and absorbing costs. Today's tariffs present greater challenges, but there are still signs that deals can eventually be reached. For long-term investors, the challenging market environment has created more attractive valuations across sectors, while rising interest rates offer enhanced portfolio income opportunities despite bond market volatility. Next, this chart tracks the performance of several currencies over the past 2 years, with the value of each currency re-indexed to 100 at the start of the period. It highlights that currency volatility has increased globally, with the US dollar index recently falling to the low end of its 3-year range, contrary to expectations that tariffs would boost dollar value. China's economy faces its own problems as well. China's GDP growth slowed to 5.4% year over year in late 2024, and economists have dropped their 2025 forecasts to below the 5% government target. The Chinese government is considering additional stimulus measures beyond last year's significant measures, including a 10 trillion yuan package. The People's Bank of China has also allowed the yuan to weaken to its lowest level since September of 2023. A weaker currency potentially offsets tariffs through cheaper exports, but this strategy risks capital outflows and further financial instability. Finally, there have been investor concerns that moves in the bond market may have been caused by China selling off U.S. treasuries. While it's difficult to verify, it's important to keep in mind that China only holds about 2.1% of total U.S. government debt, as shown in this chart. Most treasury securities are owned domestically by U.S. individuals, corporations, and government entities. While China reducing its treasury holdings could cause short-term treasury volatility, countries hold U.S. treasuries for an important reason. The U.S. dollar and treasuries are still the most stable in the world, and these assets have maintained their safe haven status. Despite U.S.-China trade tensions creating uncertainty, financial markets have proven resilient long-term, suggesting diversified portfolios aligned with long-term goals remain the best approach. Investors should expect these tensions to continue, regardless of how tariffs evolve in the coming months. We hope you found these insights helpful. If you would like to discuss any market or economic concerns, please don't hesitate to reach out. We look forward to speaking with you.